For those of you who don't know who I am, my name is Matthew Marcoux, and I'm Senior Wealth Advisor here at Candor Path Financial. And I'm joined by our amazing Director of Investments and Wealth Advisor, Mr. Michael Scott. Michael Scott is a CFA, that stands for Chartered Financial Analyst. And so, because of that designation, Michael leads us in our discussion regards to the economy and regards to the market, and has his hands in each one of your portfolios. So today we're going to hear from him, talk about 3 or 4 different topics that we wanted to at least lead with that was important to us. And then, of course, we want to hear from all of you. If there's any questions you have, we will go ahead and take those live. And if there's none, that's also okay. I know sometimes people are a little shy to ask a question. Again, there's always the option after this to connect with us, and we will talk to you one-on-one. So without further ado, welcome, Michael. How are you doing today, sir? And what's new with you since our last update, gosh, right before the summer?
Oh, good morning, Matt. Not a whole lot, man. I've switched houses. I actually got a new opportunity to move. I had to give up my 2.7% interest rate and move into something a little bit higher. So that was kind of a downside, but not a whole lot's going on. It's good to be with you this morning. I'm sorry John's not with us. He's enjoying his vacation a little bit out there at the beach, but ready to hop into a couple things here.
Awesome. Good. Well, let's get started. So we wanted to first start with the markets, right? I think that's why a lot of people probably popped on or listening to this. They want to know about the markets. They want to know about GDP and some of these big headlines that we've been seeing over the last 30 days or so. So let's start there, Michael. Let's talk about the markets and let's talk about where clients are seeing their portfolios go right now.
Great. So I don't know about you, but it feels like just 2 months ago it was February. And the year's kind of just flown by, and we're talking at the end of the third quarter here, moving into the first week of the fourth quarter. And when we look back, we want to know what the performance of the markets have been. And generally speaking, when we think about the markets, for us, we first talk about the US markets. That's generally the S&P 500 for us. And that index is up about 22% as of the end of September or Monday's night's close. Now, that's not the index that you may see on TV when you see big headlines like the market was up 500 points today or something like that. That actually refers to the Dow, and the Dow's up a little bit less than that. But by and large, it's been a strong year domestically. Not to be outdone, we've actually seen a pretty good year coming internationally. When we look at a broad index for international stocks, we look at the All Country World Index ex-US. So we remove the US, and that index is up almost 14% for the year as well. So strong performance there. And finally, when we look at bonds, because that's a big slice of a lot of people's portfolios, the aggregate bond index is up about 4.5% through the end of the year. So your blended portfolio is going to fall somewhere within those ranges of a mix between stocks, bonds, and international securities.
Now, Michael, you talked about some of those indices. Is it fair statement to say, well, if the S&P 500 is up 21%, then my portfolio should be somewhere near that? Is that a fair statement to say, or are there more things happening underneath the hood that we need to explain, and typically what's not explained when you see the nightly news at night?
Yeah, both, Matt. So if your portfolio was an S&P 500 index fund only, you should be up about 22% for the year, right? That's the only thing you're tracking. But for most of us listening to this, we are not tracking the S&P 100%, and we do that for several reasons. Number one, a lot of people don't want to ride the roller coaster every single day and be tied to stocks only. So because of that, there's a mix of bonds in your portfolio. So just by removing money out of stocks, which S&P did 22, and putting money into bonds, which on average did 4.5, you're not going to be 100% equity. You're not going to get that 22% return. Now, just because you have a certain amount of equity doesn't mean all those equities are going to perform the same way as the S&P as well, because our equities get moved out between value and growth. They get moved out between quality stocks and dividend growers, or US versus international. So while the overall composite of the S&P did 22, growth stocks did something like 24, 25, 26%, while value was down closer to 16%. And if you're following at home, you're looking at that math. Well, Michael, that doesn't average to 22%. It's because there's more growth stocks in the market than there are value. So things move around a little bit and it's a weighted average. So if you're looking purely at the S&P 500 and tracking your portfolio to that, that's fine if your portfolio truly matches the S&P 500. Otherwise, we really need to get under the hood and understand how the portfolio is positioned and why it's positioned in that way. And that might help understand why performance looks the way it does.
Yeah, and when we say S&P 500 index, are we talking about 500 equally weighted stocks within an indices? Or is there something else happening when we see that come across the headlines on the news?
So actually, it's a fun fact. The S&P 500 used to be 500 stocks. It's actually now like 497 or 498 because several of those companies have two classes of stock in them, actually. So no, it's not actually 500 equally weighted. Um, it's actually a market cap weighted index. So a company like Apple, which generally is the largest company in the index, has a weighting of somewhere around 7 or 8%, while a company like Discover Financial might only be around 0.2 or 0.3% of the index. So companies like Apple and Microsoft and Google, those large mega cap companies, have a much stronger pull on the market than your banks do or other companies would in the index. So it's a very, very top heavy index. And the bottom 490 make up a bigger piece of the index than the top 10, but it's pretty close to being equal there.
So you're saying basically the S&P 500 index is primarily made up of 7 or 10 stocks that are weighted about 50%, and then the 490 odd stocks, which is the other 50%. From outsider looking in, it sounds like it's this um, nice blended index that we can base our portfolio off of. But when you actually really look at it, if you weren't invested in those 7 stocks, or you're doing a combination of value and growth, and you don't have those 7, or have not concentrated in those 7, you end up having a much different outcome at the end.
Yeah, that's one of the pitfalls of stock picking, right? If you look at the S&P 500 index and you want to go out and grab 20 stocks or 30 stocks to own, you got to make a decision, one, on which stocks it is, and then you got to make the decision on how to weight them, right? Because let's say you buy Apple, and Apple's the number one performer in the S&P. I'm not saying it is this year, but hypothetically speaking, it was. Not only do you have to pick to buy Apple, but you also have to pick the right weighting. Because if you underweight Apple relative to the index, maybe you pick 20 stocks and you wanted them all to be equal, you can own Apple, pick the right company, and you're still not going to match its performance because you own less of it than the index does. So the index of the S&P is great at getting you exposure to the largest stock market in the world, one of the greatest countries in the world, but it is oftentimes not, or it should not be, the cornerstone or only investment in your portfolio that you look at for equities. Because go back to 2022, as good as those top 10, top 7 stocks were in 23 and 24 and 21, they were atrocious in 2022 and they did not do very well. And those other stocks around them, your more value-oriented stocks, actually outperformed significantly. So having a blend between them really matters to smooth out the years that they don't work the right way.
Yeah, great point. So let's transition a bit away from the markets and let's kind of talk about where we are from a GDP standpoint, because that's really what a lot of these indices are then based off of, right? Is our country growing? Is it expanding, or is it contracting right now? And where are your thoughts on where our current GDP is?
So We're actually in a really interesting spot this year because GDP is continuing to trend higher than where we thought it was, or even the Federal Reserve thought it was going to be for 2024, which is the same trend for 2023 as well, actually. So this year we saw Q1 come in at 2.9% growth. Q2 was 3% growth. And all indicators are pointing to about a 3% growth in Q3 as well. So other than the small zero point 0.1 miss in Q1, we're looking at about a 3% year so far, which is actually really good for the economy. And there's some reasons to dig into that. But the economy is growing at a 3% rate continually, which then benefits stocks, benefits the market overall.
So the economy is expanding. Why did we just cut interest rates by 50 basis points? That's typically done to help boost the economy a little bit. Why would we reduce rates if expansion seems to be fine and things are quite nominal right now from an economic standpoint?
Yeah, so I think that's probably the biggest theme this quarter was when would the Federal Reserve, or if they would, cut rates in the third quarter or into the end of the year. And part of that is because inflation has been trending lower. So going back to 2021, when we got all this money coming in from the federal government in different programs, different stimulus checks, payroll protection programs, all these different things, that made consumers and businesses flush with cash at a time in which supply chains broke down. The combination of that led to a severe bout of inflation. Now, I have some charts here that I don't want to be too technical or too nerdy on this, but we'll look at real quick. That's going to show really the story of inflation here. So this is a chart from JP Morgan, where we go back to 2021, you can see where inflation really began to lift off. We had a history of it being down around 2% from the financial crisis onward, and then we began to jump rapidly through 2021 to 2022. And we peaked at about a 9.1% inflation rate. And 2022 was, and moving into 2023, that was crippling to a lot of consumers and businesses alike, because just going to the grocery store felt more expensive. And as this continued, the Federal Reserve began their interest rate hiking cycle. And their goal was to bring rates up to lower demand. And the hope was that they could do this without eroding economic growth and eroding the labor market. And we actually got rates up to about 5.25%. And we got our last rate hike in somewhere around here in the summer of 2023. Now, we were sitting in the mid fours for most of the beginning of 2023. Inflation was beginning to roll over, partly because of base effects and math. So interest rates look 12 months back. So they look at what is the rate of inflation today compared to 12 months ago. And that's how it gets put together. So in June of 2022, prices were 9.1% higher than they were in June of 2021. When we get to January of 2023, it's about 5% higher than they were in January of 2022, which was about 7% higher than they were in January of 2021. So it was still getting more expensive, but the rate at which it was getting more expensive was going down. Now, we finally hit a rate where interest rates were having an effect on the economy and bringing the cost of inflation lower. Now, as you can see, as we went through 2023 to 2024, we settled out around 3%, had a slight blip to start the year in 24. We're going down to 2.5% for August. Based on what gasoline did in September, we think we could get down to around 2.3% for September. The reason the Federal Reserve is cutting rates right now is because they set policy back when inflation was about 5%. And as inflation has been cut in half down to 2.5%, they're still applying the same amount of pressure to the economy in the form of interest rates. And as inflation begins to lower and continue lowering, the brakes break harder on the economy, even though we're not adding any more pressure, or it begins to bite harder into the economy. So this 50-point cut was really done to relieve an artificial tightening that the Federal Reserve did not want to have in place. They're not saying that there's anything weak in the economy today. Actually, they're quite surprised by how strong it is and how good the labor market's remaining. But we need to back off interest rates a little bit. Otherwise, we will begin over tightening, and the thought of ruining a soft landing into a hard landing becomes more possible.
Great information there. I love this because so much when we talk about raising or reducing rates, we're doing it. And you made this point the other day when we were talking, is you're either raising or reducing into weakness or into strength. And the unique thing about the interest rate change that just occurred is that we are still in strength and reducing rates. And I thought that was a really unique way of doing it, because the last time we changed rates was right before after COVID, right after COVID, is as a mechanism to stimulate the economy, is what is what occurred there. And there was a real purpose behind it, and there still is a purpose here, but that purpose is more of to alleviate and to allow that soft landing to take place, and to hopefully avoid a recession, which you just talked about. A recession takes 2 quarters of negative GDP, amongst a few other now new metrics that they're adding to that. And at 3%, which is what you just stated a little while ago, doesn't look like there's a recession coming at least anytime soon, based upon the numbers coming out of what we're seeing.
Yeah, in addition, what's interesting is that not only is GDP staying around 3% at the moment with interest rates where they are, earnings for companies are beginning to accelerate. So back in 2023, we actually had what's an earnings recession, where the economy doesn't recess, but mathematically the earnings go down. Well, in 2024, earnings are now growing again. So not only are we seeing the economy in aggregate stay together, we're seeing companies begin to report better earnings. And as that continues, that supports why the market is sitting at new highs today, because we're seeing earnings growth and the market is forward looking and wants to see that continue. So we actually feel relatively confident. I feel relatively confident about the economy at the moment. That's not to say that we could not have a hiccup down the road, that there could be something in 2025 that shifts us in the course. But today, when we look around, we've got inflation falling, we've got interest rates coming down, we have earnings growth occurring, and we have GDP growth occurring. Like it's kind of a good scenario all around for us.
So what's the only thing that could cause throw a wrench into the gears and cause any of this to change? And it leads to my next question to you. We are shooting this economic update here on October 2nd. Yesterday, October 1st, Governor Walz and Senator Vance just decided to have their debate, and we got to hear from both of them last night. So my next question for you leads into the election. And let's talk through, we talked about this last time on our last economic update. Things change now. We have a little bit more clarity on where things are going. Let's talk about the election, Michael. How does this impact our economy? How does this impact our markets? And how does this impact our clients financially? Because that's the only part we can really talk through here. And we know it's a very sensitive topic. Just so you know, we are most of the time politically agnostic in these meetings, not because that's our belief, but it's because when we are working with our clients, we have got to look at things objectively. So we try to keep our personal beliefs out of it and just look at things either mathematically or using some level of a metric to be able to deliver this information. So let's have that conversation about the election. Depending on which way it goes, do we change our portfolios around? Are we looking to go into cash right now prior to the election to mitigate any volatility? What is our game plan here for really the next, call it 30 to 45 days?
I feel like I always get these great questions where you ask, what could mess this up? Now let's talk about the election in that order. Now, I say that, and I say that jokingly. I'll make this blanket statement at the beginning. I don't think the outcome of the election is going to have an outsized impact on markets over the long run. Now, that does not mean each candidate does not have certain policies that they want to enact or not enact or repeal. There is really important legislation that could be done. For example, what's the number one thing that comes to mind for myself when I think about this next election? The Trump tax cuts sunset at the end of 2025. And Matt, you know a lot about the specifics around this, but because those tax cuts were passed in a reconciliatory manner, they have to expire in a said period of time. So that time period is coming up, which means personal rates could change. The standard deduction was doubled. That could go back, get cut in half. Do we get the personal exemption back? There's questions about the SALT tax cap. The estate levels right now are, almost 13 million a piece, somewhere around there. That gets almost cut in half as well. And if nothing's done, not even to mention corporate rates could change. So I think that's a very, very important piece to look at when we think about policy for this election. Now, I'm going to get into a little election math, and then I'll bring you in here, Max. I'm interested to hear on some of the specifics. But when we look at the landscape right now, toss up in the presidency. Every week, I feel like I hear it's back and forth. Trump has a lead or Harris has a lead. Probably a toss up today on October 2nd. The Senate map is very favorable to Republicans currently, based on who is up for re-election and seats that have to be won or lost. Things that come to mind: Joe Manchin, a Democrat from West Virginia, almost assuredly will be replaced by a Republican. And then, there's different states that are voting. A lot of them look very favorable for Republicans right now. So we could see a Republican majority, not a super majority, but a majority in the Senate. The House, on the other hand, looks a little bit more favorable for Democrats. So even if you throw out the presidential race, looks like potentially a blue House and a red Senate, which means no one's going to get the way they want on these tax cuts. So, Matt, what are some of the key provisions, some of these tax cuts that are changing?
Well, you mentioned a few of them, and I think the first one is for small business. And there's what's called the QBI deduction, which is the qualified business income deduction, which is hugely impactful for small and medium-sized businesses, as that's keeping a level tax rate for them. So that's the first one. I think the second one you mentioned there was the estate tax. And again, currently right now it's at right around $13 million you can die with. If you die with $13,001, that $1 over gets taxed at about 40%. When I first started this industry 22 years ago or so, those numbers were $4 and $5 million. And so very much impactful. There's a lot of planning built around that. And then for the next 15, 17 years, the numbers went up so high, they were indexed with inflation from 10 million, 11 million, 13 million, that level of planning just involves such a very small percentage of the population that it wasn't as big of a deal. So seeing those revert back is something that I think is impactful. You mentioned the SALT deduction. I look at our list of clients that are listening here today, and I see Pennsylvania on here. I see New Jersey on here. I see New York on here. And when I see those states, right now, you are limited to deducting the first $10,000 of taxes. Well, I know there's a lot of high income earners on our call today. And so you're not taking the full advantage or being able to take a full advantage of the deduction you pay towards the state tax on your federal income tax. So sometimes there isn't a changing of the actual rates. Sometimes it's a reduction of credits, a reduction of deductions, and the byproduct of those increase the overall tax rate itself without physically changing the rates. But that is one of those elements as well that will potentially change is the actual rates themselves. So those are the things we're looking at right now. And there's not much we can do. I'm in a job of planning and I can't plan for that. So we are just living by the rules that are given to us and then hopefully making some assumptions throughout those and seeing which way they might go. But so much of this is up in the air and it's out of our hands. Our job
Yeah.
is to work within the rules and learn the rules really, really well so we know the ins and outs and how to treat our clients in the best way.
Which I think is really important because just as that's our job as planners and advisors and yourself as a tax professional as well, um, Wall Street and Main Street alike, they may have personal feelings on the election from a business sense. They really don't care on who wins. They just want to know what the rules are, and then they're going to play within the rules to their biggest advantage, which is why I go back to my first statement. Um, I don't think the outcome of the election has a sizable impact on the economic 20 years of this country. And the reason I say that, going back to sharing some more things, is when we look at history, and by the way, this is not the first contentious election we've ever had. 2000 was kind of contentious as well. Um, Overall, here, this is a look at the S&P 500 total returns of the S&P 500 market during presidential election years. Now, it's going back from 2024. Now, this number was through June, so that number needs to get a little higher at 22% down here in the quarter. But overwhelmingly so, presidential election years are actually pretty positive for the market. Despite some volatility that may be within them, they're still pretty positive. Now, there's two outliers here, 2000 and 2008. 2008, we were in the depths of the financial crisis. And then 2000, we were right in the middle of the dot-com bubble bursting. If you look back to 1948 and 1960, those numbers don't include dividends. If you add dividends in, they could very well be positive or flat. So I don't think specifically a presidential election year should be feared in the markets. History says it shouldn't be, and we're actually tracking to have a pretty good year. Now, it doesn't always feel that way. And I think that's one of the things that we want to talk about here is that this was a study done by the Pew Research Center in conjunction with JP Morgan, and they surveyed people that self-identified themselves as Democrat or leaning Democrat or Republican or leaning Republican, and then asked them to rate the economy on a scale. And this is the percentage of people that rated the economy as either good or great, essentially, on the scale, and the percentage of those respondents. So red for Republicans, blue for Democrats. You'd see the most recent ratings. Only 10% of Republican or lean Republican individuals said the economy was good or great, compared to 41% of Democrats today. Now, there's a couple interesting things that line out, that show up here. In 2008, 2009, we all agreed that things kind of stunk. That's one of the only times we've agreed. What's also interesting here is that the inflection point around the elections. So if you look at the 2016 elections, the start of 2017 here, nothing happened within 2 months for Republicans to go from a sub 20 approval rating to up to 40 to a height of over 80%, except for Donald Trump won the election. Similarly, Democrats never really excited about the future of economic growth, even under Obama. And I don't mean that in a negative way, but if we look, they peak at about 45% under Obama, stay relatively flatline under Trump, and then get down during COVID. Suddenly in 2021, when still a lot of the country was locked down, they feel amazingly better within 6 months. Our perceptions and our emotions dictate how we view things in the economy and in the markets. And what's really interesting to me here, whether you're a Democrat or Republican, if you look at the returns of presidents, Obama actually has the best return of an average annual return of 16.3% to Trump's 16%. Biden is catching up at 13.2. Now, economic growth for Obama and Trump, very, very close together at 1.8 to 2.2. You could make the argument that Trump's economy at 2016 was doing pretty well, so he continued it going, and Obama had a lower base to go off of. down here, and that's a fair argument, but the market supported themselves regardless. And if you allow your views politically to dictate how you invest, can have lasting effects on the portfolio, which is why I think goes back to your first question, Matt. Like, what are we going to do around the recession or the recession around the election? At the moment, nothing, because nothing dictates we to do anything. That doesn't mean we're not watching it. If tax rates move severely unfavorably, that's going to dictate some changes. Doesn't mean,
And that's why,
yeah,
and I started this with that. That's why we come to these meetings politically agnostic. And again, not because we don't have, we're not founded in our own beliefs, which we all are, but our job is to be objective. And what this chart really shows me is if my person's going to win, I think everything's going to be great. And if my person doesn't win, I think everything's going to crap. And I think in some situations that has bled over. But in terms of what we try to do is we can't go into these meetings with our own beliefs. We have to look at things mathematically, and we have to be able to apply history to some of it. And this chart, I really do love, and I actually show it in a lot of our meetings because I want to bring everyone a little bit closer to center and say, let's look at this objectively rather than through the lenses of a political environment, because that can really skew our outlook at times.
absolutely. And I think that's the takeaway message. In portfolios around elections and policy shifts, there are some tactical things that could be done. But by and large, it should not change. If you're a 70-30 investor today, you're probably a 70-30 investor in March of next year, unless something in your life changed.
Great point. Well, we promise to keep this light, try to keep it condensed in time. We're at about 30 minutes here today. I don't see any questions coming through from any of our live participants. Michael, anything wrapping up, closing for us?
I think the biggest thing that I'm left taking away from today is that the biggest theme for the third quarter was, when is the Federal Reserve going to cut rates? And we saw them begin cutting, and it looks like they may do one or two more cuts this year. They're not cutting because there's something wrong with the economy. Quite frankly, the economy is doing very good today, and it may not even needed the cut based on economic conditions today. However, we are seeing inflation continuing to trend lower. And as that inflation goes lower, we get artificially tighter in the economy. So this is a more of an adjustment cut to keep financial conditions the way they are today, to keep that inflation trend going lower. It's not because we're concerned that there's economic downtimes coming around the corner. And I think that's the number one thing that we need to keep an eye on as investors and as advisors, to just be comfortable that things are okay today, and we don't have a catalyst for them to become un-okay at the moment.
And when they do become not okay, we'll be the first to reach out to you guys, talk through it, and make sure in our meetings we're covering each and every one of these topics, not so that you become the expert in this, but so that you can understand what's going through our heads when we're building the portfolio, when we're making those investment moves and those changes.